Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. First up, U.S. stock futures, little change this morning as investors await the Federal Reserve rate decision today. The central bank expected to leave interest rates unchanged today for a fifth straight meeting. Traders will be closely watching Jerome Powell's press conference for any hint that the central bank is moving closer to a cut. Tune into Yahoo Finance at 2 p.m. Eastern today for the full coverage on the Fed rate decision and at 2:30 for Jay Powell's news conference. Plus, GDP and ADP data out this morning offering the latest read into the U.S. economy. The first read on second quarter GDP coming in at 3% for the quarter year on year. The estimate was for 2.6%. And meanwhile, ADP employment data coming in hot for July at 104,000, with the estimate for 76,000 jobs to have been added last month. Investors will get the latest read on the labor market this Friday from the government in the July jobs report. And Meta and Microsoft earnings due out after the bell today. Investors will be closely watching the results for the latest read on the AI trade. Part of the focus will be on how much the tech giants plan to spend to keep up with competitors like Alphabet and Amazon as they build out infrastructure and software to power artificial intelligence applications. The companies face a high bar, though, for the results, having both rallied 40% from their April lows. Let's get a check now on stock futures. We are seeing all three major averages point to very slight gains at the open here. We did see a little bit of a boost, though, from the GDP data as well. But right now, the Nasdaq is gaining the most, or indicating the biggest gain of the three, and it's not even up 0.2%. Look for a lot of individual stock action today as the earnings deluge continues in the markets. Let's get to our top stories of the day. The Federal Reserve expected to hold interest rates steady despite continued pressure from President Trump to cut and growing dissent among Fed governors. Also, fresh economic data giving us a read on the health of the economy and the state of the labor market. Plus, big tech earnings on deck with Microsoft and Meta set to report after the closing bell. Joining me now, senior reporters Brooke DePalma and Josh Schafer. Josh, let's start with you. You're following that data that we got this morning, GDP and ADP. What do we need to know?
Yeah, Julie, so headline numbers for both would tell you that there was a bit of a rebound in both those metrics, right? So ADP showed private payrolls grew a little bit over 100,000 in the month of July. That was after contracting. Private payrolls were cut by 22,000 in June. So you're seeing a rebound there. But kind of key is the trend, right? So I was just speaking with ADP chief economist Neil Richardson. And when you look at the actual chart of ADP, over the last 3 months, the trend has been slower. And we're still seeing slowing overall in the labor market. You can see it essentially highlighted in light blue on your screen now. The trend over that 3 months, if you average them out, or really 4 months, would be slower than what we were seeing at the beginning of the year. And if you flip over to GDP, kind of a similar story. So yes, Julie, you just talked about that headline number, the U.S. economy growing at an annualized rate of 3%. Of course, that's a big rebound from the 0.5% contraction that we saw. But there is a little bit of devil in the details when it comes to that GDP release. So growth in sales to private domestic purchasers, this is a part of the GDP release that economists often reference as a true sign of final demand. That increased just 1.2% in the second quarter, down from 1.9%. And the lowest that we've seen since 2022. So again, inside both of these releases, the headline numbers look like, okay, rebound, strong economy. Inside, you're still seeing some signs of slowing, not necessarily contracting or breaking or any of those really ominous terms, but still slowing kind of is the direction here.
Right, and of course, I think it bears reminding for folks that that first quarter number that showed the contraction was in part because of the sort of inventory weirdness of that first quarter, right, where people ordered, or companies, I should say, ordered a lot of inventory to try to get ahead of the tariffs, and that sort of skewed the numbers. So that's something to keep in mind as well. It's Fed Day, as we've been talking about, so this economic data has some importance. This isn't necessarily the stuff that the Fed is paying the most attention to, but what are the sort of implications for the Fed, Josh, and how should we be thinking about those various Fed members?
Yeah, it's interesting. So when you think about just the private payrolls number, one of the things that Fed Governor Christopher Waller, who has said that he wanted the Fed to cut in July, we'll see if he actually is a dissenting official at 2 p.m. today, but he had cited stall speed private payroll growth. I'm not quite sure that the numbers that you're getting from ADP are really reflecting that at this point. So again, Neela Richardson, the chief economist over there, said that it's really just showing slowing at this point. But what she did point out is she still thinks payrolls are growing enough to support the consumer. And when we talk about the labor market, that's sort of the key question here, right? Would be, are enough people getting jobs and getting pay bumps as they get jobs to support consumer spending? Richardson looks at a 7% year-over-year growth rate for people that switch jobs and a 4.4% year-over-year growth rate in July for people that stay at jobs, and say Americans are still getting paid. Yes, the hiring momentum in the U.S. economy and the U.S. labor market has slowed, but for now, people are still able to eventually find jobs and eventually see wage increases that are above inflation, and that's sort of the key to the overall macro story. So when you sort of relate that to the Fed, it seems like it would defend the case that they could be in a place to hold rates and sort of wait for more data to see if we do see further slowing in terms of the labor market.
Right, and it certainly looks like that is how Jay Powell is going to position them today. Then the question turns to, is he going to give us any clues as to how the Fed is positioning itself going forward, right, Brooke? And I know a lot of investors and commentators are looking to that question also.
Absolutely, and it's largely because of this limelight, this spotlight that Jerome Powell has been under as President Trump has been urging the Federal Reserve to cut interest rates. And so this will be a unique meeting in that the large expectation is that they're going to hold rates steady despite this pressure that they're getting from the administration. And Krishna Guhan from Evercore ISI saying in a note this morning that the Fed is really trying to hold on to its independence here. Of course, the Federal Reserve is independent from the administration, but they went on to say that to Powell's credit, however, he is resisting both the pressure to yield to premature cuts and the temptation to make a point of being hawkish. Now, he said recognizing the only way to uphold independence here is really to try to make the right play based upon the available information. And that's rhetoric that we've heard from the Federal Reserve time after time, that they're going to take a look at the data. Now, Deutsche Bank also saying in a note that they do expect the committee to repeat what they have said in the past, with the unemployment rate remains low and labor market conditions remain solid. Once again, we're getting a key jobs report out this Friday where unemployment is expected to tick just slightly higher to 4.2%. They also said that they expect the bulk, not the entire committee, but the bulk of the committee anticipates that inflation will pick up further over the coming months, leaving officials cautious about signaling when it might be appropriate to next reduce rates. Of course, inflation and the jobs report are two key factors that the Fed really takes into consideration around rate cuts, that is. And so largely those will be two things that the Fed will be watching here as well. And so hold rates steady is the name of the game as today.
Yeah, most definitely. So when we're looking, and when you guys are looking around a commentary, Brooke, what are people seeing as the sort of potential risk for the markets that just continue to push higher, especially because, yes, we're talking a lot about the Fed, but we're still in the midst of earnings season?
Absolutely. Meta and Microsoft really being a key factor here when it comes to the markets. The potential risk here, rather, in the markets. Citi's Stuart Kaiser saying this morning that earnings are the biggest risk here for the markets. He went on to say the large cap tech earnings and guidance are the largest immediate risk to equity markets, assuming there's no huge surprise when it comes to the Fed and the labor market. And so really all eyes will be on earnings growth and guidance from both Meta and Microsoft today.
And Josh, you've been on the lookout for data on sort of how companies are reacting to their numbers. What's the latest? Yeah,
Julie. So Julian Emanuel over at Evercore does a great job tracking this essentially every morning throughout earnings season. And what Emanuel highlighted this morning is if you look across whether it's a company beats on sales but misses earnings estimates, or misses on both, or beats on both, et cetera, everything is above the 5-year average. So right now you're looking at the one-day price reaction when a company beats on both. That's seeing a average stock rise of 1.6% versus the long-term average or 5-year average of 0.8. Of course, misses are being treated significantly worse right now. So you take a look at that. If a company misses on both earnings and sales estimates, their stock is falling 5% in the next day of action. That's above the 5-year average of 3.2%. And so to sort of connect these two theories of what Brooke was just discussing, right? When we think about what's been leading the market higher as we've sort of just been drifting, there's been a lot of movement under the surface, right? But your large cap tech trade has held up. Large cap tech has been steady, and that can sort of hold up the market when all of these other companies are moving. Well, now you look to tonight, you have Microsoft and Meta reporting. If those companies have large moves off of earnings and they are not to the upside, that sort of creates your key risk there, right? We've had a lot of movement under the surface with smaller market cap companies in the S&P 500, but now what happens to the leaders is sort of the looming question over the next 48 hours.
Yeah, the pressure is on. Brooke, Josh, thank you. Appreciate it. And stay with Yahoo Finance all day for more coverage on the Federal Reserve. We'll be speaking to Paul Krugman, author and Nobel laureate in economics, as well as Esther George, the former president and CEO of the Federal Reserve Bank of Kansas City. Plus, of course, we'll bring you the decision live at 2 p.m. Eastern, followed by Fed Chair Jay Powell's press conference at 2:30 p.m. Eastern. Well, another round of Magnificent Seven earnings are due out after the bell on Wednesday. Both Meta and Microsoft will report their latest quarterly results. Here with what to expect, Yahoo Finance tech editor Dan Howley. Dan, let's start with Microsoft. I assume Azure growth will be a big part of what we're looking at.
Yeah, Azure growth, last quarter they had seen a very good growth in Azure, but they said it was also buoyed by non-AI spending. So that's something I think that people are going to want to keep an eye on. Is that kind of trend going to continue? I think the other thing is obviously going to be AI and what that has to do with Azure growth. We had seen them report 16 percentage points of growth in Azure were attributable to AI. So we're looking to see where that goes. Projections are a little more than 17%. They started reporting this a few quarters ago just to give a better sense of what AI is doing for the company. No direct revenue line there, though. But, okay, we'll take that. As far as the quarter goes, we're expecting adjusted EPS of $3.37 on revenue of $37.89 billion. That would be up from $2.95 and $64.72 billion in the same period last year. And then as far as Intelligent Cloud, that's where they have Azure built in. We're expecting $29.09 billion in revenue. That would be up 22% year over year. And yeah, the percentage that would be attributed to Azure would be 17.25 percentage points. I think one of the other things to look at is going to be what's going on with the Windows computers and the PC growth. Do they see pull forward or pull in? Are people upgrading now as the end life of Windows 10 comes around? That's supposed to be a big catalyst. And then, yeah, I think the idea of this whole AI on someone's computer, the Copilot, what's going on there, is that driving any growth for Microsoft?
Very interesting. Well, speaking of AI, Meta is also coming out with its numbers, and it has really, maybe more than any of these other companies, and that's saying a lot, really talked up AI. We know about Meta hiring away people, paying crazy sums of money for talent. How is that all going to translate? What do we need to focus on for the quarter?
Yeah, I mean, look, the big deal for Meta is that they can kind of show where their AI is, kind of benefiting them directly right now, right? Whether that's on the advertising side or on the user engagement side. During their last earnings call, Zuckerberg had said that they were testing new ads recommendation models for Reels. That has already increased conversion rates by 5%. They're seeing 30% more advertisers using AI creative tools. So that means that they're seeing this turn now where AI is helping to drive at least part of the business. So we're going to be all eyes on that, what the spending is, because apparently they were offering ungodly sums of money to hire some folks over there. And then for the quarter, we're expecting EPS of $5.89 on revenue of $44.83 billion.
And then this morning, ahead of earnings, interestingly, Mark Zuckerberg comes out with his vision for superintelligence, whatever superintelligence means.
Yeah.
What did he say?
Yeah, I mean, this is something that's, they've talked up superintelligence a lot. What is it exactly? We haven't gotten a firm understanding. And we were talking before the show, all these companies are kind of zhuzhing this idea of artificial general intelligence, these, smarter than human computers. What's the definition of that? It's really in the eye of the beholder at this point, I think. But we do have a cut from Zuck giving his kind of explanation as to what he sees the future being for Facebook or Meta in their AI role.
I believe deeply in building personal superintelligence for everyone. And at Meta, we have the resources to build the massive infrastructure required and the ability to deliver new technology to billions of people. I'm excited to build this future, and we've got a lot more to come soon.
So yeah, obviously, it's kind of vague. I think he has a longer kind of essay that he's also released where he says that he believes that personal superintelligence will help people achieve their goals, create what they see, what they want to see in the world, experience an adventure, be a better friend, and grow to be able to be the person they are. He does kind of say that they're distinct from other industries who believe superintelligence should be directed centrally towards automating all valuable work, and that humanity will live on a dole of its output. So basically saying, look, we don't want to automate the life out of everything. We want to give this to you as kind of a tool, or have people use it as a tool to kind of get rid of the mundane kind of things. And he references specifically people spend less time with productivity software and more time creating and connecting. So it's an interesting take on where they're kind of pushing it. We've seen, some folks warn of what happens if all of this goes automated. Look, is there going to be automation that takes away jobs? Absolutely.
It already seems to be happening.
Right. You can't say that it's not going to happen.
Right.
I think the bigger question is then, okay, outside of work, where does AI live then?
It'll help you be a better friend, according to Mark Zuckerberg.
I want to be a good guy, and that's going to do it.
Sure. Dan, thank you. Looking forward to those earnings this afternoon. Now time for some of today's trending tickers. We are watching Humana, Seagate Technologies, and Palo Alto Networks. First up, Humana on the rise this morning after the insurer raised its full-year earnings outlook after strong second quarter results. The company's guidance lift comes after rivals like United Health and Centene reinstated lower than expected guidance thanks to pressure from rising costs and government plans. Humana expects Medicare Advantage membership to decline by up to 500,000 members this year, but that's less than previously estimated. That better-than-expected membership decline also prompted the company to reiterate the higher end of its full-year revenue outlook. Next up is Seagate Technologies. Its outlook fell short of analysts' expectations, even after the computer hardware manufacturer delivered better-than-expected fourth-quarter results. Wall Street remains optimistic on the name, however. Analysts at Cantor Fitzgerald upgraded the stock to overweight from neutral, writing they still see, quote, meaningful upside to the shares. Mizuho and Rosenblatt also raising their price targets on the stock, and it's risen more than 100% since April's market lows. It was trading near record highs earlier this week before the pullback this morning. And finally, Palo Alto has officially reached a deal to buy CyberArk Software. It is valued at $25 billion. The transaction expected to close in the second half of the company's fiscal 2026. Palo Alto Networks clients will receive access to a suite of identity security tools, which they say will be beneficial as companies integrate AI agents in their workforce. That's according to Bloomberg intelligence analysts as well. The Wall Street Journal had reported that acquisition talks were being held on Tuesday, so now the company's confirming. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up, we'll count you down to the opening bell on Wall Street. Don't go anywhere. You're watching Morning Brief on Yahoo Finance. Meta and Microsoft set to report earnings after the closing bell. Will those results spark more demand for growth stocks, or is big tech's rally set to stall? Joining us for a look is our markets correspondent, Josh Schafer, with another slice of the chart book.
Hey, Julie, yes, I want to focus in on one of our big tech charts from our chart book, which of course spanned a lot of topics, including markets and the economy, but big tech was obviously a key part of what folks were talking about. This chart comes from Vinu Krishna over at Barclays, and what Vinu is pointing out here, we're looking at in yellow, it is near-term earnings growth. Green would be multiple expansion, so that would be stocks rising, not necessarily with their earnings growth, and purple is your price return, sort of the spread in between those two things. The key one to focus on here as we're talking about big tech is, of course, the only square that we have on here where next 12-month earnings growth has actually risen more than the price year to date. And so what that tells someone like Krishna is, yes, earnings growth has been strong for big tech. Also, perhaps it means that big tech would have more room to run if they continue to beat consensus. One thing Krishna has followed for several quarters now, of course, is analysts often do not have earnings estimates that come in below or that are lower than what companies report. That has specifically been true for big tech. These companies have been consistent beaters, meaning that this yellow line would probably continue to rise on our chart here over the next 12 months. And if earnings continue to accelerate in big tech, as we saw this last quarter, where people thought the growth rate was slowing, it wasn't actually slowing as much as people thought. That spawned a rally in some of these big tech stocks. Krishna argues that that will likely happen again this quarter. Of course, we're going to find out pretty early tonight, Julie, with whether or not that trend is still in place.
Yes, we're going to get more clues for sure. Thanks, Josh. Appreciate it. And as we wait for those big tech earnings, are valuations looking to overstretch? Is there still entry points into that massive AI-driven tech rally? Let's bring in Kevin Mon, Hennian and Walsh CIO. Kevin, it's great to see you. So you just heard what Josh was talking about. In other words, basically the thesis of that chart is that the gains that we've seen in these stocks are largely supported by growth in earnings for big tech names. That said, is it too late to get in after we've seen, this year a rally in many of those stocks?
Yeah, it's certainly not too late to take part in the AI revolution. In fact, I would still contend that we're just in batting practice of a double header as it relates to the AI revolution. And where we are right now is really in the infrastructure build out, building out the AI factories, using the data centers, the cooling solutions, and utilities to power those solutions. Once we get into the actual games, the double headers, if you will, that's when large cap tech is going to start to apply these sophisticated algorithms to actually change the manner in which we operate as a society and the manner in which our economy actually functions. So investors need to be patient and recognize that the return on investment is likely not going to come for years down the road for all of this big CapEx spending that's taking place. But the earnings results from TSM, certainly very encouraging. I expect to hear more good news on the AI and CapEx front from Microsoft today and Meta as well. So to answer your question, Jules, it is not too late to get invested in these names.
So all of that said, what does that imply then for the larger market, right? The records that we see day after day after day, we know are being fueled at least in part by these large cap tech stocks, which are so heavily weighted in the averages. Is that just going to keep on going?
It's a great question. So last week we had a golden week where the market actually closed at an all new time high all 5 days of the week. We've seen a tremendous bounce back in the markets from the initial onset of tariffs in early April. In fact, from day 74 of this year to the end of the second quarter, the market's up over 20%. That tells me that we're going to have to be a lot more selective, Jules, to find pockets of growth opportunities in the second half of the year. Some of these AI names, certainly worthy of considering. Aerospace and defense names, given all the announced spending that's taking place across the globe in defense, another good place to look. And also muni bonds, because that's one of the few asset classes that really haven't rebounded thus far in 2025.
Now, Kevin, I know we're sort of a broken record on the tariff issue, but I got to ask about it, especially with the president saying this morning that tariffs on India are going to be 25%. Does the market care at any point?
It seems to me, Jules, as though the market has now moved past the most dire consequences of these tariffs, believing that ultimately we're going to strike trade agreements similar to what we saw with the European Union and Japan, perhaps having a 15% base tariff rate as the worst case. Of course, time will tell if that proves out to be the case. But it strikes me that markets have moved past the tariff threats and are now squared focusedly in on the Federal Reserve this afternoon, what they announced for today, and all likelihood what that means for the balance of this year.
Kevin, great to see you. Thanks a lot.
Yeah, thanks so much.
That does it for Morning Brief. Stay tuned for Opening Bid with Brian Sozzi. Keep it right here.